So in the first quarter of 2026, the oldest community bank in the U.S. made this highly calculated, honestly, almost uncharacteristic financial maneuver.
Oh, yeah, the provision jump.
Right. They quietly took $4 million of pure operational profit and just, effectively locked it away in a vault.
Which is huge for them.
It is. So today, we're doing a deep dive into the Q1 2026 earnings report for Washington Trust Bancorp, ticker symbol WASH. We pulled these filings from MarketBeat and Cord, and, we're going to use this regional bank's quarterly ledger. It's sort of a set of seismic sensors for the broader 2026 economy.
I love that analogy because, Washington Trust was founded in 1800, right?
Yeah, exactly, 1800.
Right, so an institution that navigated the War of 1812, the Great Depression, the 2008 crisis, and a global pandemic. They don't just guess at economic trends, they model them meticulously.
Exactly. They've seen it all.
And the durability of that institution really provides a unique baseline for us. When a bank with a 226-year track record of conservative underwriting suddenly, alters its balance sheet mechanics like this.
It's a huge red flag.
Yeah, it signals a shift in the macroeconomic environment that the broader, aggregated national data just obscures.
Okay, so let's unpack this, starting with what looks like a really stark contradiction in the top-line numbers.
Right, the net income.
Yeah. For the first quarter of 2026, Washington Trust reported a net income of $12.6 million, which is 66 cents per diluted share.
Pretty solid on the surface.
Yeah, and their CEO, Edward O. Ned Handy III, he actually included a statement praising the solid results.
Naturally.
Right. He specifically pointed to the strength of their core banking business and highlighted an increase in their net interest margin, which hit 2.63%.
Okay.
But, and here's the catch, if you look at the quarter-over-quarter data, their net income in Q4 of 2025 was $16.0 million.
Right, so it went down.
Yeah, we're looking at a $3.4 million drop in actual profit.
Yeah.
To use a retail analogy, this feels like a grocery store claiming they had a phenomenal quarter because their markup on apples is higher than ever.
Even though the overall revenue is down.
Exactly. Even though their actual bottom line revenue shrank by over 20%. Make it make sense.
Well, what's fascinating here is how that grocery store analogy actually highlights the difference between operational efficiency and net earnings.
Okay.
The CEO is directing investors to look at the net interest margin, or NIM, because that metric represents the fundamental spread between the bank's cost of liabilities, like, customer deposits.
Right, what they pay us for keeping our money there.
Exactly, and the yield on its assets, like the loans they give out.
Oh, I see.
Net income can be skewed by one-time accounting events, but NIM is really the structural pulse of a bank's daily operations.
So we're looking at a classic net interest margin expansion here.
Just like
The report actually notes that this 2.63% NIM is a 7 basis point increase from the previous quarter and a 34 basis point jump from Q1 of 2025.
That's a healthy expansion.
Yeah, and they specifically attribute this benefit to a balance sheet repositioning that they executed back in December 2024.
Ah, right. That was a big move.
It was. It implies they took some deliberate medicine, like a little over a year ago, to set up this current expansion.
Yeah, they likely shed lower-yielding bonds or, underwater securities that they accumulated during the low-rate environment of the early 2020s.
Right. They just bit the bullet, recognized those losses, and redeployed that capital at the higher 2025 and 2026 market rates.
And the timing of that December 2024 repositioning is critical context here. A lot of regional banks hesitated to realize those bond portfolio losses.
They were just holding out hope.
Exactly, hoping the Fed would aggressively cut rates and bail out their underwater securities.
But Washington Trust didn't wait.
No, they chose to restructure early. By taking the hit and optimizing their asset mix then, they locked in a structurally higher yield on their earning assets.
Wow.
Yeah, that 34 basis point year-over-year expansion proves the underlying machinery of their loan generation is vastly outperforming its historical baseline.
Totally independent of the final net income figure.
Exactly.
But, that structural outperformance makes the missing $3.4 million between Q4 and Q1 even more glaring, doesn't it?
It really does.
If the fundamental spread is generating stronger returns on the money they manage, that profit didn't just evaporate due to, operational inefficiency.
Right, it had to be deliberately reallocated before it reached the bottom line.
So following the money, The reallocation of those funds reveals the specific vulnerabilities their risk models are flagging.
We have to look at the line item for credit loss provisions. That's where you see where that capital was diverted.
Right. Let me lay out the figures from the asset quality data, because the velocity of this shift is just startling.
It really is a massive jump.
Yeah. In the last quarter of 2025, their provision for credit losses was a highly manageable $600,000.
Pocket change for a bank that size.
Exactly. But in this quarter, Q1 2026, it accelerates to $4.0 million.
Wow.
Yeah, and because of that sudden capital diversion, their total allowance for credit losses, the cumulative reserve fund.
A rainy day fund, basically.
Right, that now sits at $41.1 million. That equates to 0.82% of their total loans.
Okay, but here's the thing.
Right.
The detail that demands attention is their actual net charge-offs.
Right, a charge-off being like unrecoverable debt that is officially written down.
Exactly. Money they actually lost. For this entire quarter, their actual net charge-offs were only $10,000.
So wait, they only actually lost 10 grand this quarter, but they shoved $4 million into a lockbox.
Yeah.
Are they bleeding money behind the scenes, or are they just getting paranoid?
Well, the disparity between $10,000 in realized losses and $4 million in forward-looking provisions, that is the defining mechanism of modern bank accounting.
Okay, break that down for us.
Under the current expected credit losses standard, or CECL.
CECO, right?
Right.
Yeah.
Under CECL, banks are no longer permitted to operate on an incurred loss model.
I mean, they can't just wait for a borrower to default before reserving capital against that loss.
Exactly. They are operating on a predictive model. They aren't looking at the 10 grand they lost today.
They're looking ahead.
Right. They are legally required to synthesize macroeconomic forecasts, specific local market stressors, and the granular health of their current loan book to project future losses over the lifetime of those assets.
Oh, wow. So that $4 million provision is essentially them pre-funding the pain.
That's a perfect way to put it. It legally reduces their on-paper profit for Q1, but it builds a fortified capital buffer against a very specific modeled threat.
This illustrates a fundamental principle of risk management, right?
Right.
Knowledge is most valuable when it's understood and applied.
Exactly. By recognizing the localized stress in their portfolio early, they apply that knowledge defensively.
Tightening the balance sheet before the realized defaults actually hit.
Right.
But, I mean, if a highly conservative bank is bracing for an impact of this magnitude, it forces us to look for the exact epicenter of the threat.
Yeah, they aren't guessing. They've isolated a specific vulnerability in their loan book.
And the non-accrual data points a massive red arrow right at it.
Oh, absolutely. And just for context, non-accrual status is the leading indicator of profound distress.
That means the borrowers just stopped making interest payments, right?
Right, and the bank can't recognize that expected interest as income anymore.
Well, the aggregate non-accrual loans for Washington Trust spiked from $12.9 million at the end of 2025
What?
to $40.4 million by March of 2026.
That is a staggering jump in 3 months.
It is. And
Yes.
the earnings release specifically isolates the catalyst for this surge. It's literally just 2 commercial real estate office loans.
Only 2.
Just 2. And to put this in perspective, out of their $2.08 billion total commercial real estate portfolio, office space is a relatively small slice.
Right, it's not their main thing.
No, it makes up just 11%, or roughly $231 million.
The concentration of risk is vital to analyze here. I mean, a $27.5 million surge in non-accrual status coming from just 2 assets.
2 assets.
Right, within an 11% subsegment of their commercial book that indicates a severe structural failure in a very specific asset class.
And here's where it gets really interesting.
Oh, yeah.
The report breaks down the specific asset quality data within that failing office segment. Of the $28.9 million of office loans currently sitting in non-accrual status, a staggering $22.3 million is categorized as Class A office space.
Class A, wow.
Yeah, and an additional $6.5 million is categorized as lab space.
That is wild. Because we generally assume Class A real estate represents the absolute highest tier of commercial property, right?
Right. Premium amenities, prime locations. Historically, it's the safest collateral on a bank's balance sheet.
And lab space, I mean, particularly in the life sciences sector, that was heavily touted as the ultimate post-pandemic safe haven.
Because research and development can't be conducted remotely in a home office.
Exactly. So the failure of top-tier collateral, like Class A and lab space, really challenges the conventional wisdom regarding commercial real estate resilience in
It
2026.
totally does.
And this raises an important question about the delayed mechanics of commercial lending.
Because we are, what, several years removed from the initial shift toward hybrid and remote work models?
Right. So the fact that these defaults are manifesting so violently now, it requires us to examine the typical maturity structure of commercial debt.
Meaning we have to look at the refinancing cycle.
Precisely. Commercial mortgages don't operate on a 30-year fixed amortization schedule like residential properties do.
No, they're typically written as 5 to 10-year loans, right?
Right. And the borrower often makes interest-only payments during that term, relying on a huge balloon payment at maturity.
Which they almost always satisfy by just securing a new loan.
Exactly. They just roll it over. That refinancing mechanism is the linchpin.
Okay, so map that onto these Class A buildings.
So consider a premium Class A asset that secured a 10-year loan package back in 2016, or maybe a 7-year package in 2019.
Right before everything changed.
Exactly. Throughout the early 2020s, the sponsor continued making regular interest payments based on low pre-inflationary interest rates.
And they were sustained by long-term corporate leases that were signed before the structural shift in office utilization.
Yes. The leases basically act as a delayed fuse.
Right, because even if a corporation realized in, say, 2022 that they only needed half their square footage, they were contractually bound to pay rent until their 7 or 10-year lease expired in 2025 or 2026.
Exactly. So the building owner's cash flow remained ostensibly stable on paper.
Masking the underlying drop in the building's true market utility.
Yes. But when those leases finally expire and the tenant downsizes or just vacates entirely,
The building's net operating income completely collapses.
it collapses. And this operational collapse coincides precisely with the maturity of the underlying commercial loan.
Ouch.
Yeah, so the sponsor arrives at the refinancing table in 2026 facing a devastating combination of variables.
Interest rates are significantly higher, demanding greater debt service payments.
Right. And at the exact same time, the underlying collateral value of their half-empty building has absolutely plummeted.
So it creates a fatal breach of loan-to-value covenants.
Exactly. If a building was appraised at $100 million in 2019, securing a $70 million loan, the math worked.
But if that building is reappraised today at like $60 million due to high vacancy and elevated capitalization rates?
The bank mathematically cannot roll over a $70 million note on a $60 million building.
No, of course not. The sponsor would be required to inject tens of millions of dollars in fresh equity just to close the gap.
Capital that simply does not exist in the current commercial ecosystem.
Wow. So the sponsor's only rational economic choice at that juncture is to walk away, handing the keys to the bank.
Yeah, and that dynamic explains why Washington Trust is dealing with high-profile non-accruals today. Even fully occupied lab space faces a similar math problem if it was underwritten at the absolute peak of the 2021 life sciences real estate bubble.
Right. The 2026 valuation just cannot support the maturity payoff at current interest rates.
And the earnings report actually quantifies the looming scale of this exact maturity wall.
Yes, it does. Get this. 59% of Washington Trust's total commercial real estate office balance is scheduled to mature before March of 2028.
Over half.
More than half of their exposure to this highly stressed sector is going to hit that refinancing bottleneck within the next 24 months.
So that $4 million provision we talked about?
It isn't an overreaction at all.
Not at all. It is a mathematical imperative based on the expiration schedule of their commercial loan book.
Wow. And if a highly capitalized, historically cautious institution is marking down Class A collateral to this degree, it serves as a proxy for the entire regional banking sector.
Oh, without a doubt. Hundreds of billions of dollars in commercial real estate debt held by mid-sized banks nationwide are approaching this exact maturity cliff.
But this presents a really compelling paradox within the broader earnings release.
How so?
Well, we've just detailed a severe structural erosion in the corporate real estate sector. Yet Washington Trust is maintaining a total risk-based capital ratio of 13.38%.
Which is a very robust indicator of overall financial stability.
Right. Furthermore, they are sustaining a 56-cent quarterly dividend payout to their shareholders.
Right, they're still paying out.
Yeah. If their commercial real estate exposure is generating millions in non-accrual distress, there has to be an incredibly powerful counterbalance elsewhere on the balance sheet absorbing those shockwaves.
And there is. The counterbalance lies in their consumer and fee-based divisions.
Okay.
To understand how they maintain that capital ratio and the dividend, We really have to analyze the performance of their retail operations and wealth management services.
So the data on the consumer side outlines a completely different economic reality.
Completely different.
Mortgage banking revenues surged by 32% compared to the first quarter of 2025.
Huge jump.
Yeah, and wealth management revenues grew by 8% year over year, with the division currently managing $7.49 billion in assets under administration.
And look at the deposits.
Right, on the retail deposit side, their in-market deposits expanded by 3% from March of last year, crossing the $5.1 billion threshold.
And home equity, too.
Yep, consumer home equity loans saw year-over-year growth of nearly $20 million.
The significance of the wealth management and mortgage banking performance really lies in their revenue structure.
How do you mean?
Well, these divisions generate substantial non-interest fee income. They are remarkably capital-light compared to commercial lending.
Oh, that makes sense.
Yeah, managing a $7.49 billion wealth portfolio produces a recurring, predictable stream of advisory fees without requiring the bank to lock up its own Tier 1 capital in highly leveraged, decade-long real estate bets.
So the wealth management division basically acts as a financial shield.
Exactly. And the 32% spike in mortgage banking revenue points to a stabilizing residential housing market in early 2026.
Everyday consumers are adjusting to the prevailing rate environment, securing mortgages, and tapping into home equity.
And the contrast there is what's telling. Residential real estate remains highly functional, driven by individual household resilience.
While corporate real estate faces systemic repricing.
Right. And the 3% growth in in-market deposits is equally vital to their operational defense.
Because by increasing their deposit base to over $5.1 billion, Washington Trust lowers its overall cost of funding, right?
You got it. Access to local, relatively stable consumer deposits is far cheaper than relying on wholesale borrowing from the Federal Home Loan Bank or the broader capital market.
Wow. So it all connects back to the net interest margin expansion we discussed at the very beginning.
It circles right back.
The everyday consumer, keeping their payroll in a checking account and utilizing a home equity line of credit, is directly fueling the bank's fundamental profitability.
Main Street is subsidizing Wall Street.
Literally. The reliable yield generated by Main Street consumers is essentially subsidizing the defensive capital reserves required to offset the failures in Wall Street-grade commercial real estate.
And if we connect this to the bigger picture, this Q1 2026 earnings report is an immaculate microcosm of the broader U.S. economy.
Yeah, we are witnessing a starkly bifurcated landscape.
Traditional capital-intensive corporate sectors are undergoing a painful structural contraction forced by changing behavioral paradigms and stringent refinancing math.
Simultaneously, the consumer sector demonstrates sustained liquidity and a robust capacity to absorb elevated borrowing costs.
It's fascinating.
We started by looking at a dense collection of financial tables and SEC filings, but unpacking the accounting mechanics from net interest margin spreads to CECL provisioning models.
It reveals the underlying narrative.
It really does. The narrative of a 226-year-old institution navigating a profoundly complex macroeconomic transition. Washington Trust is aggressively sacrificing short-term paper profit to construct a capital fortress against a known, approaching wave of Class A commercial loan maturities.
And they possess the capacity to execute this defensive strategy solely because of the enduring cash-generating power of their retail depositors and wealth management clients.
Right. So what does this all mean for you, the listener? Well, when you examine the broader financial markets, you now understand the mechanics beneath the headline metrics.
You know how to track the divergence between operational yield and future loss provisioning.
Yes, and you understand how the expiration schedule of commercial debt dictates the timeline of economic stress.
And building on that realization, consider the cascading effects of that commercial maturity wall well beyond the banking sector.
Ooh, tell us more.
If regional banks are bracing for widespread defaults in top-tier corporate real estate because those buildings cannot mathematically be refinanced at their previous valuations,
Right.
those properties will inevitably be reassessed at a fraction of their former worth.
And property taxes are inherently tied to those assessed values.
Exactly. When the multi-hundred-million-dollar office towers making up your city's skyline are officially marked down by 40 or 50%, the municipal tax revenue generated by those commercial districts will plummet.
Oh, wow. The shortfall in the city budget will have to be reconciled.
Yep, which means the consequences of those failing 10-year commercial leases will ultimately be passed down to the residential taxpayer.
Man, So the structural shift in corporate real estate eventually lands right on the local homeowner's doorstep.
It really does.
Yeah, that is a vital dynamic to monitor as we move through 2026. Thank you for joining us on this deep dive. Keep examining the data behind the headlines, and we will catch you next time.